Hey guys, Lennon here from Passivo Real Estate Investments. I'm here with my partner Sony. Sony, how's it going?
How you doing?
Doing well?
Good.
Alright guys, so we're back with one of these videos. Basically it's a quick discussion, in this case about a specific report from CBRE. It's basically a quick outlook, there you have it. We're going to give you a quick summary of the outlook specifically for multifamily real estate for the year 2021. So, yes, Tony, what do you have for us?
Well, we certainly had an interesting year last year in 2020. Impact to multifamily when that whole COVID thing started was really critical, and we really thought it would have a severe impact, and it did have a significant impact. But it's about the worst scenario that you could have for multifamily investing properties. And it didn't have nearly the impact that we thought it would and we were afraid of at the very beginning.
Yeah, like we always, like we've been telling our investors, the thesis or the idea behind everything that we do, investing in multifamily, basically was proven, or the concept was proven, and it held pretty well. Actually, multifamily held better than all the other asset classes except for industrial. And I think that's kind of obvious because, well, industrial, everything went online, and a lot of people renting and buying industrial properties to hold their inventory and their online businesses and all that.
Right.
But other than that, multifamily was the better asset class out there. So, you know, obviously that's a good thing for us multifamily investors. That being said, we still COVID hit really hard. Regardless of, you know.
Yeah, it did. One of the biggest impacts that we thought we were going to see was in collections, of course, with rent moratoriums and eviction moratoriums, I should say.
Yes.
And what happened was that rent collections did go down, and some tenants who were not even qualified for the eviction moratorium took advantage of that themselves.
Yeah.
But overall, the collections from year to year going into 2020 from 2019 in comparison was only down about 1.5. So it wasn't nearly as bad as what we thought. We thought it could have dropped down for most of our properties down into the 80s or even down to the low 80s, and there have been some properties like that it certainly has hit harder.
Yeah, definitely. Yeah, that which, you know, people that or properties that were hit harder depending on the market and all that. Some of them might have actually gone down below their break-even occupancy. That's where you get in trouble. That's where capital calls start to happen. But overall, collections, yeah, they were an issue. Obviously, as owner-operators, we were not able to collect, like you mentioned, late fees, and then we had deferred payments from you know, payment plans that we had to put together to basically help our tenant base. At least give us, you know, a little bit of income. But the incentive from the government, like the payment, the checks that they sent out, basically helped a lot. So overall, yes, definitely challenges. But again, the concept of multifamily investing was definitely proven, especially in the Class B asset. Within multifamily, Class B was the best performing of Class A, Class C, and Class B. Class A was hit the hardest, and that was a little bit of a surprise because even though the tenant base in Class A rentals, Class A properties, it's the tenant base that is going to be more or better able to pay their rent. What happened was that the majority of the renters in Class A were millennials, people that were renting by lifestyle, by choice, and they were, you know, they had all these amenities, so they were in the better properties. Right. What happened is that these people, a lot of these millennials lost their jobs, or they just decided to go back home. So vacancy hit very, very hard in this specific space in the Class A. In Class C, you have an issue with collections.
Right.
Obviously, Class C renters are going to be, you know, more of blue collar renters that obviously in the service industry, and this type of line of work, they suffered more than anyone else.
Right, and that Class B was kind of right in the middle in between the two, and so they got some Class A people moving to the Class B, and more of them, I think, were less inclined to spend the more money for a Class A property, so they were, in a lot of cases, more able to afford.
Yeah. Again, and it's funny because that's what we always talk about, and that's the attractive part of Class B. And the biggest or the craziest thing that could have happened, COVID, pandemic, everyone going crazy. And again, the concept, not only for multifamily, but Class B multifamily, it seems to have been
given the biggest test it could have been given, and proved that it's more recession resistant than other commercial property types.
Yeah, and then within multifamily, then you have the urban markets and the suburban markets. Obviously, different case for each one, because the biggest impact was received by the urban market, or the properties that are in the urban areas, because a lot of the renters in these spaces, in these properties, basically decided that, well, if they're not going to have, if they're going to be able to work remotely, they don't need to be close to their offices or their headquarters in these downtown areas or whatever. They're not going to have the amenities that you have in the urban core markets, because they're closed,
Right.
Public transportation, people are going to be reluctant to that.
A lot of those properties have elevators, which they wanted to avoid, of course, being social distancing.
Yeah, correct. And then just that because of the whole COVID thing, people started giving more value to being outdoors and exercising and improving their immune system and all that. So for all of these reasons, these properties were impacted, and these markets in general, these urban markets were impacted very, very hard. Mm-hmm. And on the other hand, you have the suburban markets, which were basically, they benefited from this movement. They were still impacted, like we were mentioning before, but they outperformed during the last year, during 2020, they outperformed the urban markets.
Right.
Yeah.
And so I think, and it depends on the part of the country as well as the sub-market within metros, as what the impact was as well. I think the Midwest and the South had a little bit less impact than some of the coastal areas and the larger metro cities, of course. So that's been, I think, kind of an ongoing issue, and that was exacerbated here by this whole process.
Definitely exacerbated. Multifamily, the investment volume in general was still healthy during 2020. Actually, it was up 33% from the previous year, which is still crazy. Yeah. So definitely a hot asset class. Definitely, as people were seeing how well multifamily was holding up, they continue to invest. Okay, obviously lower than the all-time highs in 2019 or 2018. Well, anyway, from the previous year, but up 33% from the last year. So that's on the investment volume, but that volume actually was, let's say, geared towards or that activity was more geared towards the suburban markets, especially like you mentioned, the southeast and the Midwest, but the suburban areas rather than the urban core of this markets, and especially the gateway markets that were impacted the most.
Yes.
And all the big names in the country were super impacted by COVID, and especially in the multifamily space, especially you have New York, you have Boston, you have Miami, you have Washington, you have Chicago, like the biggest markets in the country.
LA and San Francisco.
LA, San Francisco, all of them suffered a lot.
Right, especially the urban core, like you said.
Yeah. But anyway, Oh, and it's worth mentioning too, if those markets suffer a lot, but the ones that held the over 2020, the whole recession basically, the ones that held better than all the other markets were in the Midwest, Indianapolis,
Right.
and in the Southeast, you have Jacksonville at the top. The other one is Greensboro and Richmond. So, and you also have Tampa. By the way, Orlando, given that the economy depends a lot on hospitality and all this,
Tourism, yeah.
was among the biggest markets. Orlando's not quite, there, but it was included in that list because of that.
Right.
But anyway, the ones that performed the best were in the Southeast. Jacksonville, we love that market. We have property there, so we're very happy that happened. And I guess overall, multifamily will have a steady recovery in 2021. Like we were just mentioning, Southeast and Midwest suburban markets are going to perform the best because of the market fundamentals, and they're going to continue to demand better income in these areas.
Yeah, and the cap rates are continuing to compress there, even, and so the prices are going up for those properties. So it continues to be a good, strong optimism in that market segment.
Yeah, and then gateway markets, they're going to be a slow recovery for this, Miami, New York, San Francisco markets. But long term, if you're a long-term investor and you have the capital, then it might make sense for you, because long-term, the upside potential in this market is going to be huge.
Okay? Yeah, those are more appreciating assets rather than cash flowing in many cases.
Yeah. Well, there you have it, guys. We're going to be sharing a link to the report with you guys, so you can check out all the details about what we were talking about. If you found value in this video and in this commentary, let us know. Please comment, share it with someone that you think needs to watch this video, and you know what to do. Ultimately, one thing, please don't forget, if you want to access our free book called The 4 Investing Rules for the New American Dream. It's a free book that we put together for you guys, and you just need to go to passivorei.com/dream, and again, it's free. Just input your email and you'll get it to your inbox. So there you have it, guys. Partner Tony, Lennon here with Passivo Real Estate Investments. See you on the next video.